Hi, everyone. Steve Wyett along with Matt Stephani. Matt, we want to talk about a couple of topics here this morning. First, the passage of the One Big Beautiful Bill, which occurred with a signing ceremony on July 4th, and also what that has now done with President Trump and how he's viewing tariffs. Let's talk about the tax bill first, Matt, if I can. There was broad bipartisan support for the extension of the majority of the Tax Cuts and Jobs Act, which was passed in 2017. But there were additional tax breaks that President Trump wanted to put into this bill, a portion of reduced taxes on tip income, on overtime income, a tax credit for seniors that are getting Social Security benefits, the ability to deduct interest costs on U.S. made cars. All of this kind of additional stuff was not necessarily from a bipartisan standpoint, but was important for the president's agenda. It did increase the cost of extending the tax plan, and that's been offset some by tariffs. So we'll talk more about that in just a minute. And the other part, Matt, that I want you to cover briefly, look, the stuff that's covering the consumer, that's important. It's not immaterial. But the biggest part of this is in the business side of it, in the expensing and shortening the depreciation period for companies to invest in manufacturing facilities, which can create jobs here now. So how do you view that now that we've gotten past the One Big Beautiful Bill, what that means for President Trump and his tariff policies as we move forward?
Steve, that's a great question. And I will tell you that the fact is the business ramifications of this bill are the most significant, particularly the immediate expensing of CapEx in the United States for manufacturing facilities. So when you look at the big fiscal picture of the United States, we know we have a lot of debt. And you and I have talked quite a bit about the fact that you have to grow your way out of debt. That's really the only option we have. And so, frankly, if you can increase manufacturing in the United States and increase capital spending, that will drive higher growth over the long term. So I think that's the most important part of this bill. And yes, there are tariffs, and we see the news flow in the media every day, and it does affect the markets in the short run. But in the long run, I think more important is this stimulus to capital spending from businesses, which grows the productive capacity of the United States and will help drive growth in the United States over the next 3, 5, 10 years. So I think that's the most important part of the bill. As for the tariffs, there's a lot of noise around them. I'm still waiting to see how they actually play out. As you know, and many of these countries have just punted down to August 1st, and so we'll have new negotiations between now and then, and we'll see what happens. As far as an economic impact and a market impact, I think the immediate expensing of CapEx is more important and may drive the economic growth beyond what our expectations are right now, even with higher tariffs coming into play.
We know that the Fed is worried or has stated a concern about tariffs causing some at least temporary increase in prices, Matt, but we have not seen that to date. And so you're right. It's still a bit of an unknown exactly how those tariffs are going to impact us. There's late breaking news, tariffs on copper, the potential for pharmaceuticals. So this is a topic that we're going to have to continue to keep an eye on. But so far, it does appear, Matt, wouldn't you agree? The economy's being able to absorb this. And we're looking for the potential, maybe short term, this is an impact, but man, as we get to 26 and 27, we're starting to see a more optimistic outlook.
That's exactly how I see it, Steve.
Thank you for joining us. We'll look forward to talking to you again soon. By the way, look for a more in-depth discussion from us next week. Matt, myself, joined by Brian Henderson, our Chief Investment Officer, as we discuss these topics and more in our outlook for the second half of 2025.